Welcome, and I'm gonna, cut to the chase. It's wonderful to have you, as Smita said, talked about your role and what you're doing with at one of the biggest platforms in the world. And I think you must introduce Plug and Play as you get into your talk. It would be wonderful for people here to know more about it. I'm also very delighted because you've chosen a topic, and the one that we talked about is just so important for India. It's important in general, of course. It's not just important because China is light years ahead, and because China and USA are 80% of deep tech and hard tech, but India needs to catch up here because doing deep tech, hard tech, and solving some real complex problems makes some huge impact to society. So I'm very glad that we're ending on that note. I'd like to hand it over to you to take it forward. Welcome.
Yeah, thank you. Yeah, thank you. I mean, again, I think my experience, I'm just going to give my perspective. I work with a lot of hard tech startups at Plug and Play. So I'm going to really go and do my presentation now, see if it's working here. So I just need to just share my screen here. Okay, can you see my screen full? Yeah. So again, today's topic is as my and Plug and Play's perspective and how we approach hard tech, and then also the hurdles that we see the startups face, and then what are the good practices for them to really employ to success. So let's see. Okay, so just a little bit about Plug and Play and background. We are one of the largest global innovation platforms in the world. These are all of our locations. Just this year, we added 10 more locations. We are heavily present, obviously, in North America, in Europe, and in Asia, APAC, Japan, and then we are actually expanding to Australia this year. We are, well, first of all, Plug and Play is a really active investor company. So in 2020, we invested in over 162 companies, mostly in the seed and early stage, but our average check size is way smaller than a normal typical VC, about $110,000. This year in 2020, our investments have gone down a little. In 2019, it was actually over 250 investments, obviously due to COVID. There has been a lot of additional rounds as well for a lot of our portfolio companies. And just of our success, we backed about 13 unicorns, and probably the most famous ones are PayPal and Dropbox and Lending Club. Also, the latest ones are Honey, that got sold to PayPal for $4 billion, and Customer that got sold to Facebook for $1 billion. So we have our investment business, but then we also have this open innovation industry programs within Plug and Play that we work with over 500 corporations. And I actually highlighted the ones in red that we encounter a lot of hard tech startups, and we work with them in ag tech, sustainability, food, energy, IoT, health, new materials, and mobility. And all these industry programs have their own ecosystem within it with all the corporations. And again, we work with the largest corporate network in the world, from Walmart to Shell to McDonald's to Coca-Cola, Pepsi, L'Oreal, you name it. We probably work with half of the Forbes 1000. And we are one of the largest accelerators. We accelerated about 2,000 startups in 2020, and we did about 5,000 startup introductions just in the US alone through deal flows. And we also launched this is actually one of our biggest achievements in 2019 and 2020. We launched our own innovation software that actually tracks the startups and updates their engagement and gives them a hyper score and engagement tracker for corporates to actually really engage with Plug and Play. So talking about hard tech, well, the first question is, I use an analogy, a founder for a soft tech startup versus a hard tech startup. I used to use an analogy of a marathon. So usually a soft tech founder is basically running a marathon, where a hard tech startup founder is actually doing an Ironman triathlon at 5,000 feet, gasping for air and counting a lot of hurdles. And what is a hard tech startup? There's a lot of different explanations, I think, but I actually heard this at MIT 3 years ago. So any startup that uses atoms as well as bits, we consider a hard tech. So anything tangible, also focused on commercializing a technology into a working tangible product. Also, a lot of times based on scientific research, also potential to solve, again, a very big and hard problem. Usually biotech companies do that. Also, I still have a doubt that the technology can be built at scale. We see this a big problem for a lot of the hard tech startups, but also usually it requires a lot of capital for commercialization and scalability. At Plug and Play, we use this technology readiness level that was actually coined by NASA in the 1970s, which works pretty well to just see where the companies are. They in the exploration stage, or are they at a functional prototype, or are they in their MVP, or are they actually going through a commercialization? A great example of hard tech that I can probably give is Tesla, or maybe a failed one like Theranos in the biotech space. As Plug and Play, what we look for startups in the hard tech space and how we evaluate them, I'm not going to go too much into this because there's a lot of bullet points, but we look at passion, we look at IP, we look at market fit. Is it a heavy MVP? You look at burn rate. So these are one of the most important ones, but I'll leave the last 10 minutes for Q&A. If anybody has questions about that, I'm happy to answer. But one of the most important thing we believe at Plug and Play, and we look at a startup, does the startup know why they exist and the reason for their existence and their purpose? Because this is the key. This is actually Simon. I'm sure a lot of people are familiar with the Simon Sinek's theory of golden circle. And this is really important, we believe, because that really communicates with the audience that you're pitching. Either this could be a VC or a corporate person that you're trying to get funding on, because you really need to connect with their limping part of their brain to actually make them trust you, and you create the loyalty and connection while you're pitching. And this is really important. And a lot of people ask, what is a good one? So I would say, and a great examples would be Warby Parker from the US. And their why is a world where everyone can see clearly, stylishly, and at affordable prices. That's why this company exists. A really famous one, Uber, transportation as reliable as running water everywhere for everyone. So that's their purpose. And PK Clean, actually, this is a company that we actually work with this founder in their new company, PK Clean. And their whole purpose is to end landfilling and create a clean, secure new energy source for a more sustainable world. Again, really strong words. And the why is, this is really good because when you're trying to attract advisors and investors, you really want them to really feel a connection with your company, and you want them to want to join your company. And the why is a great way to do that. Just talk about a typical soft tech startup really quick. When you actually have a soft tech startup, usually there's a relatively little technology risk. There's usually skills and knowledge are usually broadly transferable. You can actually replace employees and when problems arise, and distribution is cheap and fast. But when you do this with a hard tech startup, different rules apply for hard tech startups. You cannot say, I move fast and I break things. It doesn't really work in the hard tech world, especially in the biotech space, right? Now we see a lot of the vaccinations with COVID, Johnson & Johnson, which actually I got vaccinated with, just stopped because they had some blood clotting problems. So, and it just costs a lot more time and money to iterate and pivot if you actually, hit a wall. And there's obviously more regulatory and commercial scrutiny. When you come out even with a material for a car part, for example, it has to go through rigorous tests, and it costs a lot of money. And scalability is usually very capital intensive. When you try to actually really scale your business, it's really capital intensive, and you need to get more funding. And the common problems we see in the hard tech space is the first one is technology risk. Is it even possible to build? Is it even possible to scale? What we advise a lot of companies is, you have to go through an MVTV, which is a minimum viable technical validation before even MVP. And you also have to look at a lot of times market and product strategy mistakes. We advise a lot of the hard tech companies to go after markets where there's a clear and unmet need. And the reason for that is you don't want to actually succeed in technology and actually go through your MVP and know your product works, but then you clearly see later on that there is no demand for your product. It's actually a horrible thing to go through for a hard tech startup after spending all that time and money. A good example for this, for example, if you say that there is no cure for Alzheimer's disease and you're going after that to cure, that's a pretty clear unmet need. Or if you can say in the auto industry, we need batteries that needs 1,000 cycles. That is a clear unmet need. And if you're going after that market, you obviously have an advantage. Also, total available market fallacy. So everybody says that, oh my God, if I can get a 1% of this $100 billion business, I'll be rich. This is probably the worst thing you can do if you're a hard tech startup. And the reason for that is we highly suggest for hard tech startups to really look at a market segment in a big market and actually be a leader in that first and gain a competitive advantage and then expand for the total available market. Because what usually happens is total available market is so big, you're actually not focused on one area, and that kind of brings failure. Also, compatibility is pretty big. You don't want to really create a product and change everything in the world in certain industry, because then everybody actually has to invest a lot of money to either use your product or technology. You really need to find a product that a lot of corporates, when actually we introduce them to hard tech startups, the first thing they ask is, can I use this in my manufacturing processes like right now? Or do I have to change a lot of my processes? And that's a big problem. A great example of this is actually not from a startup, but if you know Michelin packs run flat tires, they came out in 2005. They said that it's the most important innovation in tires since the radial tire. Well, it failed miserably. And the reason for that is the technology was great, where you can drive 55 miles an hour for 125 miles until you get to a point where you can get your tire fixed if you have a flat tire. But for this tire to be fixed, all these shops needed to have this, the products is that cost $20,000 to fix the tire, and it actually cost twice the amount of time. So nobody really wanted to do it. So it failed after, I think, 8 years, it failed miserably. And, a company like Michelin, who's actually a leader in their own field, failed because of this compatibility issue. Also, high burn rate is a pretty big issue that we see with the hard tech startups. A lot of startups get really wrong about how long will it take to do their commercialization, and how much will it cost to actually prove their technology. And usually the prototype to product journey is way harder and longer. And this is actually a great Boston Consulting Group survey that actually was done this year with 400 deep tech startups. So one of the first failure reasons is time to market. It usually takes longer. When I tell hard tech startups, they say I can, go to market 1 year, I say, you know what, probably double it, because that's usually what happens. Also, capital intensity is a big factor, almost the same as time to market. Technology risk, as we mentioned in my previous slide, is also a big risk. You might not, because a lot of times, a lot of these hard tech startups, they come out from universities, and what looks good on paper, it usually does not look good on the commercial side. Also, there's uncertain commercial application. That's a pretty big market fit that we see. Also, the regulatory framework, especially if you're in the biotech space, if you had to work with FDA, well, good luck. It takes a lot of time to get your product approved, even if you get approval. One of the things I want to really mention, I mentioned in my previous slide, is MVTV. A lot of times you have to do this minimum viable technical validation before even you do an MVP. Usually MVP for hard tech product is really expensive. So what is a really minimum viable technical validation is you have to try to figure out the smallest, fastest, and most capital efficient way to confirm what you're proposing first is possible. And then you move to your MVP. And there's a great example with Litro. This is actually a lens company, and they were trying to show that what they propose is possible. And they needed to create a 755 megapixel image sensor. And this was not possible with what you have currently in the market. So what they did is, instead of trying to make everything themselves, which would cost them 3 years and $10 million, they connected a lot of the market lenses together to make this, as you see in the picture, this big monolithic process image sensor to prove that actually they can do the job. The same thing with Alparslan, is a satellite company. They spent about $50,000 to launch their test product, which they could have spent for an MVP about $10 million. Same thing with Tesla. When Tesla first came out with the Roadster, the chassis that they used was actually Lotus Eclipse. because they didn't want to really go through the whole process. They wanted to show really that core technology works. And another thing I want to talk about is a lot of companies and hard tech startup ask, should I go in stealth mode or not? I think one of the key aspects of why you would want to go in stealth mode, we see a lot of companies that plug and play, they actually come to plug and play in stealth mode, is because they want to focus just on their technology, not anything else. Also, they're in a high regulatory space, like if they're in biotech and it will take them 3 years to get FDA approval for a device, then it makes them sense to go in stealth mode and then actually come out when they're ready. Also, if you want to protect the idea, intellectual property, until you register your patents. Also, if you're in a really competitive market. But there are problems with this as well. You have limited market validation. If you're in stealth mode, it's harder to raise money, it's harder to hire talent, and you can basically get no revenue because you're in stealth mode. A good example of this is a Velo 3D, which is a 3D metal printing company. They raised about $90 million in their stealth mode. And the reason they did that was actually to develop and own technology through registered patents. So they actually waited until they have their patent registered. About the funding for hard tech startups, it's always hard to raise VC funding as a hard tech startup to begin with. There's also the problem of raising too much money. Yes, this could be actually a big problem. There's actually data from a lot of the accelerators that if you raise actually over $40 million in your Series A as a hard tech company, you have a very high failure rate. And the reason for that, they say, is because there's a pressure of that money to be deployed. And then also too much money, unfortunately, ruins the company culture. And for success, what we advise a lot of the hard tech startups, if you can stay in the lab longer, if you're actually coming out of a lab of a university, stay in the lab longer until you know that you actually have it figured out. Have a good fundraising plan like the one on the right. And also get government grants. Government grants are great, and they're your friend. They also have their own problems, but they're usually non-dilutive, and they require basically no payback a lot of times. Also, we also advise, if you can sell it before you make it, LOIs and pre-sales are great. Also, at Plug and Play, we do a lot of these paid pilots with corporations. And then, as I work with a lot of corporations and hard tech startups, a lot of the times, this is actually, again, a Boston Consulting Group stats on what hard tech startups or deep tech startups see as the first top 3 important resource. One of them is funding, and the other one is a customer base and market access and access to facilities, business expertise, co-development, licensing, and commercial. So these are all the stuff that actually corporations can provide to these hard tech companies. That's why we highly advise startups, instead of looking for VC money, if they're actually having a harder time, try to work with a corporation that you feel have a strategic fit to your technology, and then work to either get funding or a paid pilot, or because these big corporations can really help you a lot in a lot of areas. I want to stop there probably and take questions.
Right. Amazing. Wonderful. Thank you, Omer. And right on dot, we have 10 minutes for questions. If anyone from the audience would like to ask, of course, I'll kick it off, but you can send in your questions and we'll receive them and I'll take them up. So Omer, so very quickly, just because, I just want to, from your side, deep tech versus hard tech, we were talking about it. I've seen the term used interchangeably. Would you distinguish it, or is deep tech, hard tech more or less the same?
Yes, that's a great question, actually. I wanted to touch on it, but I really wanted to keep my presentation on time. But deep tech, I think, is a category within hard tech. Okay. Because if you think about hard tech, I don't know if, some of you guys might actually buy stuff from Kickstarter. And a lot of the Kickstarter campaigns are a lot of hard tech startups. If you look at it, they're producing hard tech materials and products. And I wouldn't say that that's really deep tech. I see companies that are coming with like new type of scooters, new type of batteries, or new type of computers or stuff. So I wouldn't say that that's really deep tech. Deep tech is more like you're really solving a big problem. You can be like, for example, maybe a failed example would be Theranos is a really deep tech company, or a company that is actually, for example, at Plug and Play, I can give an example, a company that is producing a polymer that is absorbing the heavy metal in water to create actually clean water. So that is a big problem, and they're solving, and they're using scientific technology. That's what I would call more deep tech. Not always moonshot ideas. I would say deep tech. Deep tech is basically, scientific research commercialization. That's what I want to kind of maybe explain it that way.
Okay, got it. Now, so Omer, so clearly you've explained, and it's very easy to understand that hard tech is hard. All right.
Yeah.
And now, where should hard tech startups go to? I mean, I know very successful platforms like Plug and Play, even YC will invite them, and others will too. But so for example, I was reading there's something called Oklo, which is trying to create the next generation nuclear reactor. Now, are they going to come to I know they went to YC, but will they, are accelerators of this kind the right space? Will $100,000 get them there? Or are there other, staging grounds for them?
Yeah, great question. So, YC Combinator is a big one on actually hard tech startups and investing. So Plug and Play is a little different, where our accelerated programs, we don't really ask equity. So it is really free for startups to actually come to our accelerated programs if they get accepted for their technology. It's really a win-win situation for them because, again, they're not giving up any equity, so it's non-dilutive. But also at the same time, you get to meet this big corporate network. So we match you with the corporates that are looking for what problem you're solving. So if, like, I know at Plug and Play, we had some Hyperloop technologies. I mean, Hyperloop technology, as you know, it's probably 20, 30 years out to be really commercialized. And yes, $100,000 is not really gonna probably get them somewhere, but in theory, what you are there for is to get accelerated and to meet with the right connections to really proceed further with your journey in that startup. And you can meet with VCs, you can meet with corporates that are trying to help you. So I think that's why, YC or Plug and Play is a really great place for any hard tech startup to join if there's interest for your technology. Because again, like for Plug and Play that I work at, I think if I had a startup, a hard tech startup, I would really want to come to Plug and Play because there is no downside. I mean, you're not giving up equity. There is a big chance of, we don't do a lot of hard tech investments as investment side, as you see our unicorns. Out of 13, only one of them, Guardant Health, that actually does blood tests to predict advanced cancer and for right drug delivery, is I would say the only hard tech startup that we have invested that turned out to be unicorn at Plug and Play. But we accelerate a lot of hard tech startups, and I matchmake them, a lot of them, to the corporations that they want to work with.
Interesting. That answers my question. Omer, does it make you mad? Or do you get upset by the fact that a food delivery startup will get $500 million in funding, while a hard tech startup which will find the next drug or create something which will have some great societal and human impact will have to go from pillar to post. But that's just how the VC community is structured. Or you think that's fine? Is it something we can do about it? Does it get
unfortunately, that's the downside of our financial system and the way that the VCs are set up as a 10-year entities. 10 years is usually not. If you look at graphene has been around for like 25 years. And it's still, I don't think it's still not yet fully commercialized. It's been 25 years since it came out. So for a hard tech company, for them, like a lot of the hard tech startups, especially in coatings and chemicals and materials that I work with in our platform, they have been around, like when they come to Plug and Play, some of them have been around for 6-7 years. I mean, if you have a soft tech company and if you can't commercialize within the 6-7 years, we say, you already failed.
Yep.
You should probably close down shop and go somewhere else. But for a hard tech company, that is pretty normal. So expecting a VC investing in a company like that at the beginning
Yeah.
is because of the structure they have is really not possible. It's really hard. I mean, there are some VCs that are structured for material startups, but they usually come into play at a later stage.
Right.
They come into play when you have an MVP, when they know that they're not going to, really take a risk. And a lot of times, big funds like SoftBank is going to make those big bets in those really moonshot companies because they got the money to really sustain you for a long period of time.
Yeah, I agree. And that's really a question that I've just received from the audience, and they're asking the same thing, which I think to a large extent you've answered. And the person says there's always money for scaling, but not enough for experimentation. So
yes. It's where actually corporate interaction and engagement comes into play. A lot of the corporations actually will help you with this R&D process.
Yeah.
A lot if they really see that there's a strategic fit. And for the investment side, I know that VCs are really hard to get investment from, but I in my slides I highly suggested government grants if you can get it. But again, there's also the problem with the government grants. You really need to be careful because that can also kill your company, because between a phase 1 and a phase 2 grant that you're trying to get, it's really time consuming to do the proposal. Once you do the proposal, you have phase 1 funding and you want to go to phase 2 to proceed further. They can take up a year, and really, you need to ask yourself: do you really have a year for waiting for the next funding, which is usually not the case, right? So you need to be careful about that as well. I mean, again, it's not easy for hot tech startups.
And I hear you. So on the one side, there's the government funds, which comes with its baggage and the time and other issues. VCs are structured, so that's the other side. So perhaps what Plug and Play is doing, I really like that, is corporations are probably and you're matchmaking them, and corporations and corporate venture capital may be a great place for hard tech startups to get some funding. Is that the experience that you've had?
Yes, a lot of times that happens not through investment first, but a paid pilot, right? So what we do really best at Plug and Play, what usually I don't see really outside, is we are a really technology scouting company for these big corporations, kind of like a soft consultancy where we know what the corporation wants. Like a lot of corporations that I work with, I know what their hunting grounds are. I have a meeting with them every 2 weeks. So I know what's changing and I know what they're looking for. So when I see a startup in our ecosystem or outside, I just invite them. I say, you know what, I work with this company, with this corporation, and really, you can really utilize, and you really need to meet with this corporation because they can really help you in a lot of ways. So that really works out well. Sometimes it doesn't. I mean, statistically, if I can get 1 out of 4 startups as a target and it goes through a paid pilot or an NDA, that's a pretty good number, because again, we are kind of like trying different startups. Sometimes the startup has a good technology, everything is good, strategic fit, but the material that they have, which we encounter a lot, does not really work with the materials that corporation works with. So again, there's always that technology risk that arises, but paid pilots are a way to go. And if there's a good fit with this paid pilot, then you go through the investment process or an acquisition process.
Yes. I'd like to share a number with you. So, this is, of course, deep tech, not hard tech, but research number in India is 14% of the investments, the VC funding investment in India went to deep tech. That's 14% of all investments. The interesting number is 87% of that 14% was in the AI ML space.
Yeah, we see a lot of I would say from India perspective, we have a pretty big program called Alliance to End Plastic Waste that we run 6 hubs in the world for. The whole idea is to really end plastic waste that goes into our oceans and that actually goes to our landfill. And in that program, we actually encounter a lot of startups from India, because I think India, that's a big problem, right? Waste that goes to landfill and to the rivers and water is a big problem. So we see a lot of hard tech startups coming in India space. That's what actually we want to kind of set ground in India in the next probably year. So
wonderful to hear that. And we're at 8 p.m. India time. Last thing I'd like you to do is a message or your advice to to the ecosystem at large, governments, VCs, what does India need to do, and why is China so way ahead, and what does India need to do?
Yeah, I think, going back to Europe, like I think we have offices in China, we have a heavy presence. I think you can replicate some of the stuff. Obviously, not everything is applicable to, in certain countries, but really takes bits and pieces from all different areas of the world, and from North America, from Europe, from the Scandinavian countries, and from China, and actually embed into your ecosystem. I know that there's a lot of reverse innovation happens in India. Actually talked with Dr. Salman, who's actually a colleague of Henry Chesborough, who's the one that actually coined open innovation. We chat a lot, and there's a lot of innovation that's coming out of India. I think India really needs to open up its borders for innovation, and actually welcome outside startups as well, and make their ecosystem really friendly for startups in every aspect. That's why North America is great, because if you come to North America, is way different than I would say other areas, because there's always, even if you have a crazy idea, people are not going to call you stupid. Everybody is open to any idea. That's, I think, the key.
Yes. Wonderful. That's wonderful advice. And Omer, I'd like to thank you for your time.
Thank you.
I'm sure you will see more hard tech startups in India in the years to come. I'm sure we will have you participate in that journey. Let's keep talking. And I'd like to say thank you very much for bringing this summit to a wonderful end with all this insights and inspiration, actually, for our startups and for our various stakeholders in the ecosystem. So thank you very much. And with that, I'd like to hand it back to Smita to bring an end to Ideas 2021.